sponsored by the Securities and Exchange Commission of Nigeria.
Foreign and strategic investors are pouring in millions of dollars into an insurance sector that has performed poorly on the NSE over the last 5 years. The renewed interest in the sector can be attributed to large-scale reforms like the introduction of new financial reporting standards and tighter legislation.
The National Insurance Commission and the industry are doing a number of things to strengthen the sector. They're ensuring that compulsory insurance is enforced, which means that the premiums for most insurance companies will rise. We have talked about partnering with them as the Securities and Exchange Commission so that we can do, for example, joint supervision of companies that are listed, on insurance companies that are listed on the Nigerian Stock Exchange, so that there are no corporate governance weaknesses.
Nigeria adopted the International Financial Reporting Standard in 2012, giving the sector much needed credibility.
The adoption of the IFRS, which is also coming in 2012. Initially, I think a number of us underestimated the magnitude of the impact, but not just insurance industry in this case, but you notice that we are in April now. Only maybe 2 or 3 institutions have published their 2012 IFRS. In fact, NSE, I think SEC had to extend the timing for filing. So it is good. Now you have greater comparability in financial statements. You can trust financials, and especially from the point of view of investors operating in environments where they've adopted IFRS for a long time. It's invaluable. You can look at the financials from Nigeria, compare it to companies anywhere in the world where they report under IFRS, and you don't have to worry about adjustment from NGAAP to IFRS. Everything is now standard.
It throws open your accounts completely. It's a complete X-ray of your book of business, and I think the disclosure level is comforting to investors. Investors want timely reporting. Investors want governance. They want a host of other things. I believe that with the way reforms have occurred in the industry now and the kind of regulator that we have, more and more insurance companies, will be in a better position to showcase to the investors, what they've got and give timely reporting. I believe timely reporting will also assist. I mean, if you don't get timely reporting, then investors tend to, ultimately shy away from such stocks.
If you look at the valuations at which these companies are trading, some of them are trading at 0.3 times book value. And I think what would trigger significant investment in those assets is just confidence about the quality of the financial reporting. So if someone says his book value is $100 million, is it really 100 or is it 50 or is it 30? And with the shift to IFRS that has recently been enforced, hopefully investors get a lot more confidence with insurance stock.
Another initiative that should provide more comfort to investors is a new approach to risk management created by the regulator NICOM.
The Enterprise Risk Management Framework, which in itself, at the end of the day, is designed to ensure the stability in the industry, to ensure better protection for the insured, essentially to tell us as insured that, you know what, rather than the traditional approach of looking at the risks in different silos and not paying particular attention to enterprise-wide risk, that you have to adopt a very disciplined approach to look at all key issues, be it operational, be it strategic, be it underwriting, be it reserving, from a risk management viewpoint. That is the idea, to institutionalize it, to become part and parcel. It's not something that you do now at the prompting of the regulator. It becomes part and parcel of everyday life, right from the time you enter the gate to the time you exit, and everything that happens in between.
Regulators have also addressed another major weakness through the introduction of the no premium, no cover policy. Bad debts had previously been linked to insurance brokers who failed to remit premiums to underwriters, which in turn impacted cash flows and led to loss of income from provisions for bad debts.
The enforcement of no premium, no cover on the broker's side should help reduce the incidence of bad debt. And I know that for some of the companies, if you remove the incidence of bad debt, their profit will double. The brokers handle the corporate business. The corporate business accounts for maybe about 80% or 90% of the business. A few brokers account for maybe about 50% of the business. If they don't push their clients to pay in good time, or they don't pay at all, then it impacts on the insurance company that is underwriting.
What this means is that the traditional huge receivables we used to see in the financials of insurance companies will become a thing of the past by 2014, as insurance companies would only be allowed to carry receivables from brokers of only the transactions they book in December, which will be only 1 month. This will, in the long run, ensure the liquidity, the solvency of well-run insurance companies, and therefore we can expect them, to begin to have better financial performance over the years.
The no premium, no cover depends on who you're talking to. Some people may say, oh no, it's not the way to go. You need credit in businesses and so on and so forth. But because of the peculiar nature of our industry in the past, where you've had a huge amount of outstanding premium, I think it's actually the way to go. With the no premium, no cover, yes, in the initial stage, the industry may suffer a drop because you're going to ultimately just book what you've received. You can't book a promissory business, so you have to book what you've received. So I see a J curve in the industry between 2012-13 and hopefully by 2014 we should see the industry now moving up with businesses that are genuine and booked into our books, cash levels that are high. We've actually seen that happening already. The response is quite decent, in terms of cash levels. And the more the insuring public knows that there's no premium, there's no cover if you don't pay premium, the more businesses will be booked by insurance companies.
With tighter regulation, investing in insurance is looking more attractive, making it easier for local and foreign investors to engage in mergers and acquisitions.
Insurance density is about $13. India, a country with similar socio-economic profile to ours, is $59. And our penetration is about 1% or so. Emerging market average is closer to 5%. So people see this and want to take advantage.
Insurance industry does not have the glamour of some of the other sectors. I won't mention any, but I think in terms of embedded value, quite a lot of them, have embedded values that will surprise many. Either in terms of assets they hold, or even, like I said, the prices in the market do not reflect the net assets of some of these, companies. I know an insurance company, for instance, in point of fact, there are a few insurance companies that have assets that are not quoted. And those assets are worth multiples of what is in their books. So for the long-term player and the strategic investor, buying into some of these companies, may produce, startling results, in the future.
Insurance business is not the same as banking. There's a natural tendency to assess us the way banks are assessed. We carry risks, and insurance business is typically cyclical. This year you may do very well, next year you may have paid out huge claims, and that's why you're in business, and the market needs to understand that. So it's more of a long-term type of business as opposed to, looking at insurance companies, typically the way you look at banks. Other parameters should come to play where analysts actually look at insurance companies. And I think, more and more analysts are getting to understand the balance sheets of insurance companies and how to determine companies that have a future and are strong.
Looking ahead, the combination of stricter enforcement of rules by regulators, improved financial reporting, and risk management should support the growth of insurance companies in Nigeria. This is expected to lead to the appropriate valuation of the sector and should hopefully provide bountiful returns to old and new investors.